Welcome to the CRE Report. I'm your host, Chris Berg. Really excited to share a story with you. A group of guys get into a storage. They're now building a nice portfolio, doing some 3PM, third-party management over at Turnbull Equity. Co-founders, Colby Nelson and Ryan Brown. Gentlemen, it's great to see you. I wish we were in Napa doing this, but hey, you know
I
what?
know. That'd be
This works
nice.
as well. I met them up at the Napa conference for the California Self-Storage Association. Amazing event. But I want to start with, it was just both you guys, your stories really intrigue me. You're doing some really great things in the space right now. And so, Colby, we'll start with you. If you want to just give a little bit about your background and what was sort of the inspiration behind going from, I know you've got some background in real estate with family, but then tech into self-storage and Turnbull Equity.
Yeah. Thanks. And thanks for having us here on the show. We're excited to be a part of it. Our story is kind of unique because neither Ryan and I really have like a traditional real estate background. I grew up, like you said, in a real estate family. So, real estate was the talk of dinner conversation. My dad is a developer and home builder. And then even my grandparents did like real estate investing here in the Bay Area. So kind of always knew about the power of real estate and the value of real estate. And so that was always in the back of my mind. But going to undergrad, I studied just general business. And that's actually where Ryan and I met. We met at a small private Christian university called Biola University. So we met when we were 19 years old, became close friends. We were really into cycling and doing triathlons and being active and just, dumb college students. But after graduation, I moved back up here to the Bay Area where I worked for the tech industry in various tech companies, of small startups that go out of business to big public companies that get bought out by big private equity companies and everything in between. I was working as a product manager with the engineers and designers, and I really enjoyed that occupation, but kind of always wanted to start my own thing. And then at the same time, Ryan, when he graduated, he did a bunch more schooling, went into the medical field, and eventually became an anesthesiologist. Not to speak for him, making great money, having a great career, dedicating his full life to basically doing a whole bunch of schooling. Fast forward, 12 years after school, we're just talking about, our careers and catching up. And, at the time, my wife and I, we had some residential assets that we were managing, and Ryan was buying a triplex where he lives in Long Beach. And so we just started talking about real estate and management and how we do this whole thing. He had lots of really good questions for my wife and I. And we just kind of thought like, hey, this is a great situation. We should try to like work on a project together and see if we could go just buy something on the side of our really strong careers. And so we looked at some small multifamily projects throughout the US, and this was 2022, and nothing was really interesting. The yield just wasn't really there. We started kind of listening to some podcasts, reading some articles, and kind of stumbled into self-storage. And the more that we dug into it, it just seemed like a really unique opportunity in terms of, there's this kind of growing trend of technology being built for the industry, which was really interesting to me. The fact that we can like optimize the business operations and actually really truly add value to it, and increase the value of that real estate. And so kind of all this stuff in the mix, just the more we talked about it, the more we scratched at it, just sounded really, really interesting. And so we found our first small property in Crescent City, California. It's like a 89 unit property. And we decided hey, let's just do this as a fun side project. And so that's what we did. And we bought it and we started operating. And we had this idea of doing this remote management style. We had known some other groups doing that. And so we decided to just kind of apply this idea to this small facility. But that was really our testing ground to what helped us build what eventually became like our whole management company. And so we saw some good traction and success with that small property. We bought our second property. Then we just kind of like were really motivated and excited about this whole thing. So we decided to quit our careers. So this was September of 2022. We both just completely quit our very good careers in anesthesia and in the tech industry, and we went to storage full time. And then now, fast forward 3 years, almost exactly 3 years, we own 12 properties with our investors, and then we also are starting to do third-party management, where we manage other people's properties on behalf of them, and we apply kind of this unique model that we've built out over our experience and getting kicked in the teeth a bunch. We've learned lots of things, lots of ways to do things, how not to do things, and so we thought there would be a really good opportunity to kind of apply this playbook to other owners. So that's a really long story to how we got here today, but that's where we're at.
No, great stuff. And it sets me up for some things I want to discuss a little bit more down the line. But it's interesting you bring up, the part about Ryan being an anesthesiologist. Just this morning, Ryan, it's so interesting because I want to hear your take on this, where I was on socials and I saw a guy post about, I met this doctor knocking down 800 grand a year, but he doesn't like his life. He wants to own his own business, blah, 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 blah. And so I don't know if that's your background or not, but the point being is, like, most people would see you probably be like, oh man, he's got the life, right? Like MD doing his thing. But yet you're like, no, man, I want out. I want to go buy self-storage. So walk us through your process there.
Yeah, I definitely resonate with what you said in a lot of ways. That was my life. On the outside, it looked great. My family was proud. I always wanted to achieve something that I studied hard for. So I had the schedule, I had the benefits, kind of the golden handcuffs. And there's a lot behind the story of just like going through the COVID experience. And I was faculty at the University of Southern California, and that was challenging, and just understanding how billing works and how insurance companies and their involvement in healthcare. And there's just a lot of bureaucracy involved, and also understanding my own ambitions. And then, being in surgery 50, 60 plus hours a week. And, in surgery, it's high intensity, but you also don't have windows. And I'm very much a relationship person. So I was always hustling on the side a little bit. I wouldn't call myself a natural born entrepreneur, but I would do little things like, there's a lot of women that work in the hospital. So I would hustle Christian Louboutin, the red bottom heels women wear. I would hustle those. Yeah. So I would be in surgery sun up to sundown, but I have a friend at corporate, and she was like, you can use my corporate card. I get killer deals. So not kidding. I would be getting, $1,200 red bottom heels. I would get it $250, and I would just sell them like hotcakes. And all the women in the hospital were super pumped. And that was a little phase I did. Another phase was, I sold AirPods throughout the whole hospital. And, this isn't like, I wasn't making hundreds of thousands of dollars doing it, but quick and easy and honest money. And it was fun for me just because I liked the entrepreneurial spirit, and everyone was pumped about it. And so it kind of transitioned from that to always just thinking like, how can I expand my income? How can I be tax efficient? Living in Los Angeles, like with a high W-2 income, was just a disaster. And so, buying the triplex, understanding leverage, understanding rates, buying down basis points. So I learned quick. And then I said, man, there's something to real estate, but it needs to be scalable, because to replace our careers, we're not interested in 5 to 10 locations. We want a healthy, growing organization that we can benefit from, but our team can benefit from too. So it's really going from, I can count on myself, like I'm the expert in surgery, I know what's going to go down, to where in business, you really need more than just yourself. You need a team, you need a business plan, you need honesty, integrity from lenders to investors to customers. And I like that ambition and that pressure. And they also say, like in business, like who you partner with is like who you marry. And sometimes it's very hard to find a business partner. And like very much our story is organic, and it's a blessing in disguise. But like Colby is basically family to me. So I don't have to like test him to be like, what's this hairy part of business? Can I trust him? Like it's an open book through and through. And so there's so much bandwidth that we can just grow in together through the challenges, but it's so grounded into where, the opportunity's endless. So I was stoked. I haven't been in a hospital now for 3 years, and my skills are dwindling quickly, which is difficult to process after committing to it for so long. But, just focusing on the big picture, and just the lifestyle is awesome simply because of the relationships involved. Usually I'm focused on one patient in surgery, and now I've relationships all over the country, meeting owners, meeting investors. And it's just the relationship business is something that I thrive in. I really appreciate.
I didn't think this was going to be the most important question of the day, but it clearly is. Do you still have access to the Christian Louboutins?
I do.
I do.
You do.
Email me.
Hey, we'll talk after the pod, my friend.
Yeah, you're about to get hit up a lot.
I was just going to say, I'm going to have to put your email address on that, and you and I'll definitely be chatting. So
Yeah,
that
exactly.
is fantastic. You guys both mentioned, I like how you said it, Colby, you get your teeth kicked in. What I wanted to get at from both you guys, because people are watching this going, hey, we love the self-storage asset class. You see the returns. They're very steady. But there's a lot of unknowns, right? And there's a lot of different variables. So what's probably the best thing? And Colby, I'll start with you, and then Ryan, go to you. What's the best thing that you wish you knew when you got started that you now know today going through the experience? Maybe the most important thing.
Yeah, I think, man, there's so many lessons that we've learned. I think, I don't know, just picking off some of among the top things is just like the importance of going into buying a property with a game plan. It's just.
Can I interrupt you? So
Yes.
do you mean by that? Because like when I talk to institutional guys, or you talk to people like just even kind of, personal development, hey, start with the end in mind. So are you suggesting, hey, we should have known our exit before we actually bought?
Absolutely. Your exit, or just, your general business plan of how are you going to, like in our case, if we're doing a value add deal, like how are we going to take it from what it is today to X plus dollar amount tomorrow? And what is our like concrete plan, as much as we can, that is backed in reality? How can we establish that and reliably, from this point of before we purchase this asset, make that as concrete as possible? And I think just going in with that solid plan, and uncovering as many potential deal killer red flag issues as you can before you commit to buying the deal. And some of this comes with experience, no doubt. Like we're a lot better at underwriting deals today than we were when we bought that first facility. But still, we did go through a big, with all of the education and content that's available now online for this particular asset class. I think you can definitely put together a strong case for putting together a strong plan, rather, for how you're going to operate this facility to add value and have the outcome that you ultimately want. I like to start with the end in mind. Yeah, definitely.
Yeah. Ryan, for you, how about yourself? Like, if people that are watching, hey, this is the one thing I wish I would have known that really would have helped us.
Yeah. I've been thinking the whole time Colby was talking about what I could nail it down onto one thing. And honestly, I can't, because it's so multivariable. There's so many key components that are critical. And I can go on a spiel a long ways about this, but it's not just one, it's like 100, and you need to be good at all at 100. And we're definitely developing still and growing. But I look back in our history, some of the deals we bought, if I knew what I bought today, or if I knew what I knew today, I wouldn't have bought it back then. But also I'm looking at our returns, and it's like, oh, this is actually performing better. Like if I was back in those shoes, I'd be like, heck no, take that deal away. You're crazy, but it's performed these assets really, really well for us, for the most part, to where it's interesting, even with expert knowledge, the outcome's not always going to be what you expect.
Wait, this is fascinating. So what I'm hearing you say is, knowing what I know today, Chris, I probably wouldn't have touched some of the assets that we bought in the beginning, but yet they're still overperforming how you underwrote.
Oh, lights out. Yeah. And so that's been an interesting teaching point for just me to reflect on. In particular, there was this asset that, on a square foot basis, we paid a sky high rate. I think we paid $206 a square foot, and the occupancy was in the low 70s. And I just remember being very hesitant. I think this is a good deal. And if I look at it now, like I'm very conservative when it comes to our basis, building cost, development, what's going on in the market. And I didn't have the full insight back then that I do now. But that asset's been extremely strong for us. We built the rent roll substantially. We're consistently in the 90s occupancy, and it's just so resilient, reliable. We've grown NOI substantially. And then when you're looking at an asset, it's even the minutia matters, like the small details matter, such as like, what is the average unit size? So you have 250 units. Are they 250 10 by 20s? Are they 250 5 by 10s? Because that matters, ultimately boiling down to your dollar per square foot that you can achieve and reliably achieve. And there's little things like, well, if you have a bunch of 5 by 10s, that churn and turnover is more common than turning over 10 by 30s because people are less reluctant to move in, especially with rent bumps and things. And so there's all these little things that go into this system that ultimately, what's the driver? It's net operating income. And I feel like that's one of the things that is our focus and our strength as we grow and develop is we're like fully an owner's mindset. Even we'll talk about management, but like we're owners first mindset of understanding expenses, understanding NOI, and then pushing revenue, and it all comes together. But how can we be experts at this craft? And really just being, how I used to feel going into surgery is like, I know plan A, B, C. That's what I'm striving to be in storage. It's not just, this is a great deal, let's buy it and then hand it off to a management company. It's like, no, we're going to own the accountability of this performance and we're going to treat it surgically. So all the expense items matter. What can we do? Control? What can we not control? And how can we optimize this asset?
A couple of things. I'll share a quick anecdote and then we'll get more into the question. But even a gentleman I talked with recently, and he mentioned that he had some bushes on the property, right? So he scraped those away and then started renting it out to like a kayak and a bike. And when you start to utilize cap rates, what a lot of people don't realize is all of a sudden he had an extra, I think it was $300,000 or $400,000 in value to that asset, right? Just from really small piece of the property, and it was maybe another few $100 a month, but it just goes to show when you pay attention surgically to those kind of details, what you can do to actually raise the value. Question around this other asset you mentioned is, Warren Buffett's big thing is, hey, give me a margin of safety. Like those are the three most important words in investing is margin of safety, right? And so my question for you is, what are you guys currently doing to increase your margin of safety? But secondly, because now you've had success with this asset that now you probably wouldn't touch, does that put you farther out on the risk curve? Or are you just like, hey, we got lucky, let's just take the cash, but let's continue to, be very conservative in our investments?
Yeah. It still has fed into me being conservative, and I don't look on that previous deal and be like, you know what, like maybe I should be riskier. I definitely don't have that mentality. I just have an appreciation for it now. And we're really big on understanding like what is our risk adjusted return. So we look at, being conservative with our leverage, not like maybe a lender, is aggressive and they'll give us 75% leverage. Do we actually want to take that? Because then we're looking at NOI. Where can we reasonably get NOI? Ultimately, where are we ending up on an unlevered yield on cost? So ultimately, like we don't know what future interest rates are, but how is this NOI supporting the leverage that's on it, the debt that's on it? What if interest rates go to 8, 9%? Where would this asset be? And so projecting the future year outlook, really the performance with or without debt involved, what is the asset performing on? And so really that unlevered yield on cost is an important metric for us.
Colby, anything else you want to add about margin of safety in this conversation? Or?
Well, I just wanted to say too, like it's something that we talk a lot about too, kind of in the same vein is like, how do we kind of remain? I mean, I would say we were never like, definitely not reckless, but we want to we want to keep that like aggressiveness of like, not just immediately, looking at a deal and just immediately turning it off because, these three metrics don't hit. Like we still want to have that mentality, and we're constantly balancing this of like, okay, let's dig in deeper to really see if like we can't make it work and like not just pass it off. Because we see a lot of these groups that we've interacted with, and it's even happened to us to a certain degree, but we try to force ourselves to still at least, like I said, just get more in depth and more aggressive with it, which is, it's natural. Like you become more conservative as you are in this business longer. And you have like a higher standard that you're not willing to go below or whatever, which we definitely are when it comes to like returns and keeping investor money safe and secure and having a good return. But, I think too often it just results in people like just passing by deals that could otherwise potentially actually work. And so like just this kind of dichotomy of being conservative, keeping investor money safe and producing well, but then like also still being aggressive to actually make deals happen. And I think that's something that I think we do pretty good, is just still like pushing on those deals and not just immediately getting turned off because it doesn't immediately on the surface check all of those single boxes that we need.
Ryan, you and I talked recently about this. I want to just get into this conversation on the evolution of how your mindset has changed in real estate. Here's what I'm getting at is, sounds like you guys are really focused on the unlevered yield. And you're also focused on IRR, kind of what are those most important metrics that you're looking at when you're underwriting a site. But then secondly, as you mentioned, and Colby, I want you to jump into this as well, is I think you initially came in going, hey, man, I'm just going to buy and hold these assets forever. I'm going to refi, and they're just going to sort of, give me cash flow. It's going to be great. We're now, last time we spoke, at least you're kind of going, hey, maybe there's a 5 to 7 year plan here where I recycle the capital, 1031 into, potentially bigger deals, or you didn't get into those specifics, but just talk to me about that evolution and what are you focused on when you're talking to your investors as far as what the returns are going to be?
Yeah, up to this point, we've done like the components that we place on a deal have been very conservative. So, for example, our debt for the most part has a term of 10 to 25 years. Like a lot of our assets, like literally has a 25-year fully amortized loan on it. And so we don't have a pending maturity to where it's like, okay, we have to refinance or we have to sell. And also with our investor capital, we're very upfront, like from the beginning when we speak to them, is what's their goal, what's their mentality with investing, their experience to storage even, because we're very much not like the stock market. Like, oh, it feels hot, it feels good right now, but in 6 months something changes. It's like, hey, we're going to be partners for the long term. And that's our attitude, because we might have this exit strategy, but we still want to bake in like risk adjusted safety to where, what if we don't reach this? And we're not going to have a pending maturity on a loan or an issue with a lender. And I think those metrics have been helpful to us. And then it gives us breathing room to be like, these assets cash flow. We have, a 10 plus year term on the loan. We have our investors committed to 10 years. But why not entertain opportunity to, get our investors a reasonable return? And so we explore those conversations. We don't want to be like one-sided. Like really, when we started this, I was one-sided. I was like, buy everything, never sell it. That's the snowball of wealth. But as we've grown in an organization, I'm starting to see, well, if we want a breathing, living organization that's growing, there's opportunity to be had of recycling capital and also proving out our model of, yeah, we can buy these assets, we can offer distributions, but also can we exit with successful IRRs when the opportunity arises? Are we even entertaining that? And that's something that shifted for us is, being open to that conversation.
So Colby, you talked about this. You grew up around real estate conversations. I didn't. Like IRR was like, you could have just been speaking Chinese to me, right? I don't know what you're talking about fairly recently even. So I'm curious for you, as you were approaching this and getting into business with Ryan, were you always kind of going, hey, yeah, we're going to do this sort of 5 to 7 year typical private equity model of recycling, or were you thinking more just buy and hold, or what was your?
Yeah, I think I was, so growing up in a family where my dad was a developer, and his risk tolerance knows no bounds. He has an immense level of risk tolerance. It's absolutely insane. And so, and it's worked out well. It's also gone up and down with the markets and with the real estate industry in general. And so like I've seen how tumultuous that can be. And so growing up and like as I became an adult and coming out of college, like I was more of the mindset of like, yeah, more like conservative, like Ryan was saying, like hold these assets forever. That was always my strategy in Monopoly: buy as many as I can and hold them for as long as I can. And which I do think is really good. And I kind of subscribe to that more, that type of approach to real estate holding. But then I think as we kind of matured in our business, as we've kind of seen the value that we've added with these assets, as we've just kind of further refined our strategy and what we want our business to do and what kind of our investors want and what we think, having full cycle deals can get us in terms of opportunity for even more deals. I'm starting to see more and more of that kind of I guess influence from my dad, for example, of saying like, okay, well, let's get some more deals going here. Let's maybe start to recycle these things. Let's start to build the next thing and get to the next deals. And I think having a substantial track record with good results just helps build and reinforce all of that. And so that's kind of been the evolution of like my own psyche and thinking, and I think our firm as well.
Yeah, and I think part of it too, is you've got a fiduciary responsibility to your investors, right? To ensure that you're trying to maximize the returns on their capital. And so sometimes obviously recycling it depends on your model, but I think it's interesting that you're playing all these different pieces of the chess game, right? To figure out, hey, how do we do this to maximize returns for them as well? You've talked about some of the success stories. Has there been a site that you've acquired that didn't go as you expected? And what did you learn from that?
Yeah, I would say one is probably 2 years ago, and we got it at a good basis. It looked like lights out, and the just the demographic of the customer base has been really challenging, from the delinquency and managing accounts receivable. And the saving grace in this story is we were under contract, and we were hesitant on some items we unveiled, but we really pushed for, hey, we need a price reduction. The accounts receivable is pretty ridiculous, and we just went into this location not expecting to see this amount of pain on the rent roll. So we got that reduction on our basis, and then what we kind of suspected ended up coming true is just it's a very difficult tenant base, lower income. The crime rate in the area is challenging, and so that's been learning and challenging experience for us, to where even why we're more confident in management today, because of the pain point of dealing with dishonest people and thinking that they can just leave mattresses in your drywall and give you the middle finger. And there's a lot of difficulty navigating with the tenant base that we've wanted to not stoop down to like a low emotional level, but be like, how can we be professional but also be very strict with this asset? And because we got it at a sound basis, thankfully, we've churned through a very difficult client base, but that also built out getting kicked in the teeth of just like people, we have very strict hours, but them thinking they can be there till midnight and loitering and all this stuff. So now we have an in-house security team that covers all our assets and our third-party clients. That really, we have a full-time security specialist. That's our employee. And they just monitor all of our assets every single night, 7 nights a week. And so we know we close at 9, but what's going on at 2 a.m.? And how can we adapt our cameras to have an alert if there's motion, whether it's an animal or a person? And so that challenging like demographic of those customer base has made us better as operators. And I didn't think that it would be that challenging, but it proved to be challenging, and it required a security team to be like, all right, now we have control at night. There's no more riffraff, and it's enough to just issue someone to have to move out off the property. But what if they refuse? And then what if they're just causing all this ruckus? And so it's caused us to be better operators because of it.
Yeah, it really has like tested this, our ability to do what is our game plan and what we structure our entire business to do, which is like this remote first model, this unmanned model, as it's called in the industry, with a property this troublesome. And so, it came with its struggles, but like Ryan was just alluding to, like it did make our management stronger because it had to be, because we had to basically manage our way out of these situations to have a better performing asset.
So good. So let's talk about that. Your 3PM part of the business, third-party management, for people that aren't familiar with 3PM. What made you move into that arena? Talk about how people can work with you if they're saying, hey, I'm interested in having you guys third-party manage my assets.
Yeah, it very much came as an organic growth. We didn't get into this to do third-party management for anyone. We just simply wanted to be the best managers for ourselves. And like I mentioned, with an owner's first mindset, like we're just obsessed with our monthly P&Ls. And for our investor base, just to give you some insight, we have a lot of review of each asset regularly because we do distributions to our investors on a monthly rolling basis rather than quarterly. So we're always thinking, how was last month's performance? How is it relative to the month before that? Where's our distribution landing? Where's the trend of our distributions? And so it really just got us dialed into managing our expense load. What's our tenant protection, absorption rate? How are we driving revenue? When was the last rate bumps? Were they tolerated well? What about the unit size? How's that demand? And so we had this system, like almost like a full management business just for us. But then we see a lot of opportunities when we speak to other owners, like we get phone calls. How are you guys doing this? How do you auction this? Or someone broke in. How do you manage that? And then it's like, well, we already have the system in place. It's not rewriting any model for us to bring on owner. It's just we don't own it, but we manage it the exact same way, like it's our owned assets. And in the industry, I think we're pretty unique because we're not management first, we're owners first. And that's how we view their asset. That's how we view the P&Ls. And we're obsessed with expense ratios. Just because we had to be on our management side. And we think we can bring that benefit to owners because really we don't do a lot of things. Like we're not Extra Space. We're not interested or good at 120,000 net rentable square feet, Class A downtown, elevators, 7 different entry gates and doors. Like we really do single level drive up or single level climate control. And we do it efficiently. We do it effectively, even at small sites. We have a 10,500 square foot location and we can rip an expense ratio, in 33, 34% for that low of size. That's hard to scale that when you fully stack on the tech fees, the website, the accounting, all that, it adds up quick. So we got really good at managing small assets. And so now if we have owners that, they're mom and pop and they have 20,000 square feet, we could bring them a ton of value at a very reasonable price that pushes their NOI to where we could also create an environment for them to sell their asset, not even to us. They could sell to us if we'd be interested, but they're also, our contract is month to month. So maybe they use us for 9 to 12 months to optimize their NOI. And we know the name of the game, but we're thinking big picture. Like I'm not trying to get 20 assets and hoard them. I want to bring benefit to everyone involved, whether it's the owners, whether it's the brokers, whether it's the buyers, because I'm trying to build a large organization that's healthy and reliable and an expert operator. And so if an owner hires us and sells their asset to someone else 9 months later, good for them. And we're more than willing and excited to be part of that process.
Good for you. Colby, what would you like to add, my friend?
Yeah, I mean, I don't know. I think Ryan said it perfectly. I think we're just have turned into obsessives about storage and about operating storage really well. And I think, like Ryan said, we do it in this very specific way, which is for these certain size facilities with certain layouts. It doesn't work for all storage everywhere, but I think for a lot of the storage that's out there where owners needing some help, I think we can make a really big impact for them. And again, bring that obviously high level of management, but also with that owner's mentality. And so far we've gotten really good traction. We're just, starting this platform, but we've got a lot of good traction with it so far. Some really great clients that we're working with. And so, we're just excited to bring that to other owners as well.
Yeah. I mean, a couple of things jump out to me in our conversations, and I've obviously, Ryan, had a chance to visit with you a little bit more than Colby, but just as you talk about management surgically, I think it's really important in this industry because just trying to maximize margins. And then talking to you, Ryan, it's always like, what am I doing to drive NOI? And that's the metric of the game, right? So appreciate that. If people want to reach out to you, I've got one more thing, but if people want to reach out to you, here's their websites. Want to bring that up, but any other, you want to give out your email or just say, go to the website and they can reach you through your website or.
Yeah. And just so people know, in case it's not clear, so we kind of have two companies. So Turnbull Equity, which is kind of our asset management company. That's where we do all of, the buying side of our business, which people can definitely reach us at turnbullequity.com and reach out to us if they're interested in learning more about potential investment opportunities that are coming up in the future. And then Storewell Storage is our management company. And that's storewellstorage.com, spelled like the way you see in my title on my screen, STORWELL storage.com. And people can reach us out at info@storewellstorage.com if they're interested on the management side of things. But any of those areas, you'll find us, and we'll get back to anybody who's interested really quickly.
I want to give you each the last word. I think one of the things that was obviously great in our conversation up in Napa was just we all share the same thread of our faith. So just love to hear how your faith has impacted you, been walking through this journey of business. And Colby, we'll start with you.
Oh, man. Yeah, it's been extremely important. I think starting a company, as anybody who's gone down that path, it's extremely difficult. It's like we keep saying, like getting kicked in the teeth, which is one of my favorite expressions that Ryan uses all the time. Like we get kicked in the teeth all day, every day in many different ways. And it's difficult and stressful to do that. It helps having a really good partner like Ryan and a really good team like we have built out. But, in my case, I feel I get a lot of really great comfort in my faith aspect of my life and drawing on the higher source of even of Ryan or my team or whatever, and really drawing that source to help give me comfort and guidance and calm and just an area to kind of relieve and put that stress on somebody else, gives me great comfort and is extremely helpful in this path that we're currently on. So that's just one of the ways that it's really impactful for me right now.
Thank you for that.
Yeah, one of the ways that I honestly love to talk about, I could do another hour-long podcast about this topic, but business and entrepreneurship for me is very much a spiritual journey. And that might sound strange or crazy, and this is just my own experience, but in healthcare and in anesthesia, I was very much always in control. My faith has always been important to me, and Colby and I met at a Christian university. But, when I started practicing and making the big bucks, like I was the expert. Like things would go wrong in surgery, and then I'm sending up prayers. But for the most part, I'm calling the shots. I'm the expert. I know what's up. And when you grow an organization and it's so much beyond your expertise, and you need to, how do you build culture? How do you find people that you can trust? How can you lean on them? Are you leaning on them too much? And then understanding that so much is out of my hands, that daily it's a spiritual journey for me of just resetting of the goal here is not to quote unquote be rich, because in some extent I had the easy lifestyle with the reliable paycheck, the house, the car, but that wasn't fulfilling. What's fulfilling is building meaningful relationships and people that benefit from the bigger picture. And I think that's what Colby and I want to share in the industry too, is we want to create an environment to where, people first, relationships are key. And then, the wealth follows secondarily to that. But if you're on an island with $1 billion and you're the only person because you have a bunch of storage, it's kind of a lame life. Like that sucks. But if you're with a living, breathing organization where people are, building their families and there's relationships and there's value, I get excited about it. And also I'm reminded, like, there's a lot on the line. There's a lot of pressure, personal guarantees from lenders, expectations from investors, customers that might praise you or might, be really upset with you, or employees that are mad. And so how do I manage this? And it's with a mindset of like stewardship of, I didn't build this by myself. Like I'm one of 50 people. It took people smarter than me, richer than me, more talented than me. And I'm just one piece. And so having that stewardship mentality really lets me open up, but also be like, all right, with this attitude, let's run it up to $1 billion. And let's, we want to bring everyone around us and to benefit together collectively.
Great stuff, you guys. I would, stewardship and service, right? As long as you focus on, hey, how can I serve? How can I serve? Whether it be your investors, your people in your business, your customers, it seems like that seems pretty good winning formula. So Gentlemen, thank you. Really appreciate it. Again, go to turnbullequity.com, turnbullequity.com. You can find out more about that. Also, Storewell Storage. And just reach out to them if you've got any questions and maybe want to invest in some of their assets as well. So thanks, you guys. This is the Commercial Real Estate Report. I'm Chris Berg, building generational wealth with real estate.